It's been about a year since I made my first video dictating what gold's price should be and what it should lead to in the coming years. And needless to say, in this past year, gold's price has not moved in the direction that many bearish market analysts and economists, such as myself, have been looking to see where it goes. It's been going in the opposite direction. We believe that gold should be pushing upward, precious metals should be pushing upward. They have been pushing downward, and this was in the wake of the worst closures of economies around the world that we've ever seen. So, supply production almost completely halted. Goods became more limited and scarce to find. Prices are going up, and especially going up in the past few months as measured by the CPI index. Yet gold and silver's price has not started to increase, and the question becomes why? So I created that original valuation as shown by this blue line here that values what gold is. And if you noticed here, gold did go through a bull market during the 1970s, but it really decided not to steeply climb until the late 70s when price inflation started escalating out of control. Now in the mid 70s, the CPI inflation rate did go up to 12%, but then it calmed down to about 6 to 5% before escalating very highly in the late 1970s, and that caused a huge bull market in gold as interest rates were being increased by astronomical amounts by the Federal Reserve to contain that price inflation, and the economy went through a severe recession. And that's when gold finally approached its value, and it really exceeded its value in price. And if people were smart and astute and had known about a way to formulate a value for gold, then you could have sold at this peak here and taken in your profits before gold would go through a historic 20-year bear market and basically go cold until it would reawaken from its slumber and start going into a new bull market cycle starting in the year 2000. And the way to formulate the value is very easy. I did this in my last video. I took M1 and factored in the consumer price index and then discounted the private sector economy, and that's measured by this equation up here. Now, in May 2020, the Federal Reserve decided to change the formulation of M1, and basically they added in savings deposits. I don't like to use that because if money is being put into a savings deposit, then it's not being used to buy or purchase anything directly. It has to be moved into a checking account before it's being used to buy on demand, and that's typically what's been done. So I created an approximation of it, which is basically your demand deposits, adding in your currency in circulation, and then multiplying that and giving it a 20% increase. And that tended to follow and track M1 very well, shockingly well, until the formulation was changed in May 2020. Unfortunately, it is impossible now to take the components of M1 and add those up together, which is basically the currency in circulation, demand deposits, and then other checkable deposits, because the Fed discontinued other checkable deposits. So I had to basically estimate this with a calculation. Either way, that's how you get this gold value. Now, since then, I have created a channel model to show you what gold's price should trade between, measured by this green line and this red line. The red line represents a floor price for gold, and the green line represents a ceiling price, meaning that gold should never trade below or above these two lines. If it ever does, if it trades, say, below this floor price, it is extremely undervalued, and one should be buying as much gold as possible. And then if it ever traded above the ceiling price, it is extremely overvalued and unstable and will go through a drop, and people should sell gold at least and wait until it drops to a lower, more reasonable price, and then buy gold. So essentially speaking, you can take the midpoint, the midway in between these two lines, and that would tell you whether gold is over or undervalued. So you can see that throughout most of the 1970s, gold was undervalued, and only starting in about, say, 1980, that's when it became overvalued, especially according to the valuation model that I created last August, and that signaled that gold was reaching a peak. And this is the 1970s. I brought this up because we are going through rising inflation right now. Despite the assurances of the Federal Reserve that this price inflation will be temporary, I have reason to believe that this price inflation will be more permanent than what the Fed leads on. And besides using my own metrics to determine price inflation, which I might do on a separate video, the monetarist economist Steve Hanke, who has had background experience in dealing with countries who have gone through severe bouts of hyperinflation, he has studied it out and he accurately predicted this back in January, that inflation would hit about 4 to 5% in May of this year, and it turned out exactly as he said, and he agrees with me in my take that this inflation is not going down. It's going to stay and hover around that 5% area. Now, I believe that, depending on how high inflation spikes this year, the inflation rate will be around that level, definitely. I've got it at about on an average of 4.5% per year, not counting this year. This year will be well above 4.5%, and that's just based upon the increase in the money supply and debt. But I'll go over that in another video. So back to gold. So gold will trade between this channel, and you can see all throughout time, gold always has. So when it went through a bear market in the 1980s and 1990s, it always traded in between the green and the red lines here. So the red line is nothing more than 20% of M1. It functions as part of the M1 money supply. And the green line takes M1 and factors in the stock market and then discounts it against the private sector economy. So essentially speaking, the more money that flows into the stock market, the less money is flowing into gold and silver, and vice versa. That's why in the 1970s, when stocks went through a bear market, gold did appreciate in price, and even though stocks sort of rebounded, inflation started to pick up, and while stocks flatlined, gold caught up and went through an unprecedented bull market in the 70s. And I believe that we may be going through a similar moment now in the coming years, maybe not quite as badly as the 1970s in terms of price inflation, but probably no less bullish than gold because of other factors that I'll probably cover in some future vid. So gold will trade between this channel. Now look, in the 1990s, when the stock market started to take off and the U.S. economy really boomed from tech stocks and tech businesses, as the internet started to pave way for new ways of producing at cheap and selling goods at cheaper cost, you can see that gold became heavily discounted to both its ceiling price and its valuation. Now, the ceiling price model does a great job at telling you what the high price of gold should be. However, it can be misleading, because if the stock market is heavily overvalued, as it was during the 2000s, then it tells you that its ceiling price is lower than what it will become when gold starts to track back to its real valuation as measured by this blue line. So in essence, it gives you the channel, and gold stays in between the channel, but it's important to note where the real value of gold is to show you just how undervalued it is. And so then we go into the second bull market of gold, and you can see how gold starts rising from the low of the channel up to the high of the channel here, okay? And here you can see that the ceiling price really started to take off and rise with the fall of the stock market, and gold certainly paired with it and started to increase. And then once gold reached that ceiling price, it then went through sort of a mini bear market during the 2010s and just stagnated. In the meantime, the ceiling price has done much the same. Okay, it's stagnated along with it, and even though the Fed increased the money supply by huge amounts during post-2009, it did not increase it to a level where it would force up that gold price continuously. That is until COVID hit. And once COVID hit and the government started to shut down, the Fed printed an unprecedented amount of money, more money now than ever before. They increased the money supply by 33% in 1 year, and this money supply increase is going to push up the gold price. So even though gold has stagnated, if you look at gold's floor price, it has increased and it is going to push up. Right now, gold's floor price is about $1,500 an ounce, meaning gold should never trade below $1,500 an ounce ever again. Okay? Now, what's been capping it has been this ceiling price, and the ceiling price has been very low. Why is that ceiling price very low? Because the stock market has gone through an incredible rebound since it dropped in March 2020. Now, it was my opinion that the stock market would not regain all the way up to its highs, and certainly not reach the highs that it has now, simply because price inflation would scare investors into seeking safer havens. Well, what we've seen is that price inflation has started to take off, and yet investors are pretty much still taking into account that these are special circumstances, that this inflation is temporary. They're buying into the Fed narrative that inflation is temporary. However, once it becomes evident, such as in the 1970s, that this inflation is not temporary, what will happen is that the stock market will peak and it will go through a decline. It will go through a bear market. And when it does, when that stock market goes through its bear market, that will signal the rise in gold. So right quick, I am just creating what happened with stocks during the 1970s, and this is what I'm talking about right here. So when the inflation numbers started to increase and inflation started to get up above 3.5%, that's when your stock market went into a bear market, and then that's what caused gold's original increase in the 1970s, its first jump in price. Okay, then when stocks rebounded right here in the 1970s, that's when gold went through its bear market. And then when inflation started to resurge back in the late 70s and start to reach up to 10 to 15%, that's when gold increased and went through its escalation very quickly. Okay, so what's going on now is that we might be seeing another jump in the gold price very shortly, and as my valuation model has shown that it's been pushing up and up and up, we're going to see that the ceiling price will increase. So on this chart right here, and I'll bring over this chart so you guys can see, this is the same chart that I'm showing on Fred, except I have kind of charted out where I think gold's price will go based off of a perception that the stock market will peak and sometime in August and September from higher bouts of inflation, as well as the money supply growth. So you can see that the channel of the gold price has really been cut, and it's very tight. It's a very tight channel that gold's trading in right now. So gold's trading between $1,500 and about $1,900 right now, $2,000. But essentially this ceiling will start to increase and escalate very shortly, and this model right here, this chart is exponential. So if I were to take this and show you what the price escalation would really look like, it's going to look more like something like this, where gold will start to increase very much so, very highly, very strongly in the next few years. Now this is all the way up and charted out to 2024, and that's assuming that we go through a stock market bear market starting this August and September. Now why do I think the stock market might go through a bear market is because inflation starts getting higher and if interest rates start being forced up. But that's a big thing right there, and that's what we're waiting on, is to see if we're going to go through that bear market. If the bear market happens, gold's price will shoot up. It's going to be lucrative to own. If it doesn't happen, or doesn't happen right away, then gold may linger where it is right now, but eventually due to the money supply it will be pushed up.